Hello, I am Dr. Muhammad Wajid Raza, and this is the first lecture in the course Investment and Portfolio Analysis. In the first lecture, we will cover the topic related to Introduction to Investment and Portfolio. So, overview of this lecture, two important concepts will be covered in this lecture. First of all, we will discuss what is an investment decision, and then we will give a slight touch to portfolio. And in the next step, we will also discuss investment process in detail. So overall, this lecture will cover two basic topics: introduction to investment and portfolio, and then we will shed light on investment process. So what is investment and portfolio analysis? The course title is composed of two words: portfolio and investment. So investment is a process in which we allocate our funds to profitable projects and we expect future returns from our investment decisions. Investment involves decision about future. So we save or borrow money and then allocate our funds to project which can generate future profits. By allocation, we means we invest our funds in projects which are profitable in future. So what is an investment? We have to consider many factors in every investment decision. For example, risk, preferences, level of expected returns, microeconomic conditions, macroeconomic conditions, type, period of investment, and time value of money. We will discuss these factors in detail in coming class. So if we want to visualize this whole process, the investment begins with, of course, with funds, and these funds normally come from two sources. Either we have to save some money or we can borrow some money from, and then we can start our investment process with this available fund at time t. We invest the fund and then we wait for a specific period of time so that our investment can mature, and that specific period of time is called a holding period. And then after a specific period of time, we can evaluate our investment decision to see whether it has generated any returns or not. So this is normally done at time t plus 1, and after that we either withdraw our returns and consume them or we reinvest our returns. So we can see that this is not a single step, rather it involves a series of complex steps. So where can we invest? We can allocate our funds to different options to reap rewards. For example, there are many investment opportunities where you can invest your borrowings or your savings. For example, give loans, and the reward of this investment avenue is interest. So if we invest our loan, our funds, our savings in loans, we will receive interest at time t plus 1. Another investment opportunity is that we can purchase gold, we can purchase insurance plans, we can invest in real estate, we can also buy shares or bonds or mortgages, and many more options. Or we can start a new business, and all these avenues provide a reward in the near future. For example, purchasing of gold provide a reward in the shape of value appreciation. Insurance plan provide future benefits with premium. In real estate, when we invest, we expect value appreciation in the property. From shares, we normally earn dividend in capital gains. And if we start a new business, of course it will grow and it can return profits in the future. So there are basically many options where we can invest our money. So the next important topic is what is a portfolio. So in the previous slide we have seen that many individual options we can invest in either of these options, but we can also invest in the combination of these investment, right? We can invest some part of our fund to gold, and we can invest the remaining portion in the real estate, and in the same way we can make any combination out of these available options. So in order to understand the combination, it is important to understand the concept of portfolio. So portfolio The word portfolio means combination of anything. This is normally a general meaning, and in general terminologies we can say that portfolio is the combination of anything. It can be the combination or collection of your favorite movies, it can be the combination of your favorite dress, and so on. So normally whenever we have some collection, we call it a portfolio. In financial terminologies, we define portfolio in a different way. So in finance, the portfolio means or it is the combination of financial securities or other assets in such a way that it can increase the level of expected returns at a given level of risk or minimize the level of risk at a given level of return. We will slowly understand the basic intuition behind this definition as this course proceeds. So we can invest our money in different combination of assets ranging from gold, real estate, or complex financial instruments like bond, shares, future options, cryptocurrency, and so on. Please read the work of Henry Markowitz about portfolio investment. It is one of the pioneering work about portfolio investment and investor preferences. Importance of investment. So why we normally invest? There are many reasons for investment. Like it helps us in circulation of fund, it helps us to safeguard the time value of money, it provides future returns, it provides job opportunities, it reduces the income equality, it helps in economic development, it helps to upgrade the living standards, and it helps in executing idea into practice. So normally investment is very important from an individual investor's perspective, but it is also important from the overall economic perspective. It is good for the saving or for improving the living standards of individual investor, but at the same time it provides benefits to the economy. It also helps in economic development and in money circulation. So what if we don't invest? So is there any cost if we don't invest? We have seen many advantages of investment, but what if an investor does not want to invest his or her savings? So will it of course he will not be able to reap any benefits in the shape of returns from it, but will he pay any cost if he does not invest? The answer is yes. So if we do not invest, we can't earn anything on cash. And another important cost is that if we don't invest, the purchasing power of cash diminishes because of inflation and because of time value of money. This means that if savers do not invest their saving, they will not only lose possible returns on their saving, but will also lose value of their money due to inflation. Finally, we will not play our role in the overall development of our economy. So it means that if we do not invest, we actually are paying a cost. And in the coming slides, we will shed light on this issue, that what is the cost of not investing your savings. So let's talk about investment process. In the previous slides, we have mentioned that investment is not a single step. Rather, it is composed of a series of integrated steps. So overall, if we combine these steps, it is called investment process. And it's very important to mention that investment is a comprehensive process rather than a single step. As you can see that it is composed of many steps, which starts from overall objective like the client goals, and then we have to look at the risk profile of investor. Then we have to make asset allocation, and we have to design an investment strategy. And after all this process, we have to review our investment decision to see whether we have achieved our goals or not. So in the coming slide, we will properly discuss this process in 6 integrated steps. But first, let's discuss why we invest. We have already discussed some topics related to this issue in previous slide, but let's further elaborate the decision of investment. We invest because we want returns, and it also helps to reduce our risk. Investment is also helpful in compensating the inflation rate. Investment also helps to safeguard the time value of money. So all investment decisions must be able to generate positive returns. Remember, returns must be equal to compensate the time value of money, their risk and opportunity cost. So it is a very important concept to understand here, that it also help us to measure the returns from an investment. Like, how much should be the return from a specific investment? The answer lies, we have to understand three basic terminologies. A return must be equal to cover the time value of money. It must provide compensation for the risk that we are bearing in the investment decision, and after all, it should also be able to compensate the opportunity cost that we are having. So returns, these three things, like the time value of money, compensation for risk and opportunity cost, when we add these three values, it also gave us the required rate of a return on an investment opportunity. The investment process. So when we talk about investment, most of us think of buying a property, gold or some other asset with the hope of future returns. In reality, the process is very complex and it involves a series of steps, from understanding the objectives of investment to rebalancing the portfolio. So basically there are many steps, but in this lecture we are trying to discuss this whole process in 6 steps. So the investment process is composed of 6 steps, and let's visualize this whole process. So the first step is understanding the objective of investment. The second step is asset allocation. The third step is portfolio strategy. The fourth step is management or asset allocation. The fifth step is performance evaluation, while the last step is follow-up. In the next slide we will discuss each of these steps in detail. So step 1 is understanding the overall objective of the investment. It is very important to first work on the objective of the investment. So whether it's a short-term investment, whether it's a long-term investment, whether you want to gain returns from the investment opportunity, or you just want to minimize the risk, or maybe you want to maybe you are looking for a suitable trade-off between risk and return. All these steps can be clear in the first step. So before investment, it is very important to first understand what is the overall objective of the investment decision. So basic objective of investment decision is composed of integrated steps, a series of steps, and in this step we set the goals for overall investment. In addition to setting the goals, we also set time horizon for investment decision. A time horizon means whether our investment will be short term or whether it will be for long term. Also understand your client. For example, we have to look at our client and we have to assess his or her risk preferences, whether he is risk lover, whether he is risk tolerant, or whether he is risk averse. Understanding the risk preferences of the investor help us to better design an investment so that we can give or we can provide him future returns, but with the specific paradigm of his or her risk preferences. A thorough analysis of the step 1 give us an overview that this step is composed for designing the objective of the investment decision. So basically we do 2 main things here. First, we understand the basic objective of the investment, we set goals for it, then we set the time horizon for investment, but all this is done while keeping in mind the risk preferences of the investor. After this, the second step is portfolio strategy. This step is, and in this step we look at we answer the following question: how will the portfolio be managed? Normally we can manage our portfolio in 2 ways. Whether it can be managed either by with the help of or by following the active management strategy, or by following the passive investment strategy. So in this step we decide how will we manage the overall portfolio. We have to do active management or we have to do passive management. Both these strategies have pros and cons, which we will discuss later in this course. In the third step we discuss the selection step. This is the most important step, and an actual investment starts from this step. By selection we means that now that we have clearly discussed and defined the objective of the investment. We have selected an investment strategy. So now it is the time to invest our money. So where to invest? In the previous lecture slides, we have discussed that there are many investment opportunities, and in this step we decide in which single asset we have to invest, or in which single asset we should invest. It's not about only a single asset, and in this step we also decide a mix of the assets. So if you want to invest in a single step, it would be done here. If an investor is looking for a portfolio investment, then he has to make a suitable combination from the available set of investment universe. And fourth step is about weight, assignment of weight or weight allocation. Now that we have completed the selection step, from the selection step we will know that where to invest in where to invest our money. Then the second step is how much we should allocate to each asset within our portfolio. For example, in the selection step we want to invest our money partially in stocks and partially in bonds. Then the next step is how much we should invest in stock and how much we should invest in bond. The answer for this question lies in the fourth step. In this step we work on assigning weights to each of the asset class. This is a very technical concept, and we will discuss this topic in detail as this course proceed. The fifth step is like after weighting decision we have finalized our weights, so the portfolio is ready, and then we wait for a certain period of time so that our investment can mature, and then after some specific period of time we evaluate the financial performance of our portfolio. For performance evaluation we normally evaluate the risk, returns, also the downside risk, and there are many more financial performance evaluation tools that we can use to assess the financial performance of our portfolio. But in this step we learn how much returns have we generated at the cost of how much risk. So performance evaluation is very important because it helps us to see whether we have achieved our goals or not. The last step is follow-up. In this step we compare the actual performance of our portfolio with the preset goals which we have set in step first. So in some cases, if there is any deviation, we identify that deviation and then we look for the reasons underlying that deviation, and then we have to work, or we have to make a strategic plan to reduce the deviation in future. So this is all about investment decision and its 6 steps. I hope you have enjoyed this lecture. If you have any questions, you can email me or you can comment on this